Good afternoon. Good afternoon. Good afternoon. It's your resident mortgage lender. Turn that up a little bit. It's Friday. Yeah, it's Friday. All you church folks, if I'm gonna offend you, turn off the channel. Ain't nothing wrong with moving a little bit, is it? Let me stop clowning. Talking about MCCs today. Your resident mortgage lender, MCCs, right? Let me turn this stuff off so we're not interrupted. You're down with an MCC. What's that, Rob? Mortgage, credit, certificates. And if you're looking to purchase a home and you're a first-time home buyer, you're probably going to get upset if you've already purchased and you're watching this video, because this is one of the greatest things that you can have if you're a first-time home buyer, other than owning the home, right? If you're watching on Facebook, share this video. Sharing is caring. I appreciate it. If you think it might resonate with someone. If you're on YouTube, hit that subscribe button. I need to get my subscribers up. I want to get the message out to everybody. If you think this message will resonate with someone that you know. Now that we got that out of the way, we're talking about mortgage credit certificates. Monday is a holiday here in these United States. Salute to those who have served and are active duty. Appreciate the sacrifice and what you've done. And if y'all know me, I want to help the everyday man as well. So these mortgage credit certificates are for veterans. There's a special or active duty military where there's no cost to you and you don't have to be a first-time home buyer to get it. Okay, that's about a $700 benefit cost savings up front for this mortgage credit certificate. But for everyone else that qualifies under the first-time home buyer and the income requirements, you want to get in on this as well. $700 is a drop in the bucket when you see the savings that you could possibly get. So let's get into it. Let's get into it. Hello to whoever that is that has jumped on. And if you're on, leave a comment. Say something. Let me know that you can hear me. Let's do this. Let's do this. Bam. What is a mortgage credit certificate? Right? Known as an MCC. Bottom line, it's a federal tax credit that reduces the amount of the federal income tax paid by you, the homeowner, right? The credit is equivalent or equal to 20% of the mortgage interest paid during said tax year. Let's do some simple math. Say we got a $100,000 loan, okay? Just as an example, 4% interest rate, right? So let's see, 100,000 times 4%. That's $4,000 in potential taxes for that year. Multiply that times 0.20. So $800, okay? Doesn't sound like a lot, but follow me, okay? That $800 is a dollar for dollar credit, unlike the way the taxes are, or the mortgage interest that you pay currently allows you to lessen your taxable income. A mortgage credit can actually reduce your liability dollar for dollar. What are you saying? Say you have an $800 tax bill and you have this credit and you bought a $100,000 house at 4% interest, okay? That $800 will wipe out your tax bill. You wouldn't owe anything to the government, right? We the people. That's why this is very important. Let's move on. What are the eligibility requirements to receive a mortgage certificate? Okay. To qualify, all right, you must meet income limits that vary by county. And I'm talking to my Texas people right now. Let me identify that, because we do lend nationwide, but talking Texas right now. So you must meet the income limits Sometimes the income limits are expanded if you are in what we call targeted areas. Reach out to me. I'll let you know what those are. There are also requirements of you being a first-time home buyer. And the definition of a first-time home buyer, it's right on the screen. It's anyone who has not owned or had ownership in a primary residence in the past 3 years. Okay? The first-time home buyer requirement is waived for buyers or home buyers purchasing a home in a targeted area and qualified veterans. So if you're buying a home in a targeted area, or if you're a veteran, then the first-time home buyer requirements are waived. Okay, so how do you apply for an MCC? From TSHAC, Texas State Affordable Housing Corporation. You got to work with an approved lender. You in luck. I'm an approved lender. Okay, if you guys have watched any of my videos or my sentiment from the past, not a real big proponent of down payment assistance, but I've listened. And I got to give the people what they want and need, because it's a need for this. But I wanted to find one that I didn't mind putting my name behind, because this program and down payment assistance really benefits you, the borrower, in my professional opinion. I digress. So you have to deal with someone that is an approved lender with TSHAC. Once again, you're in luck. Holla at me. I can help you out. Can I combine an MCC with TSHAC down payment assistance? Yeah, you can if you qualify. As long as you meet all the other requirements, right? You can do so. So as we move forward, what type of loan can you get with an MCC? You must obtain a fixed rate mortgage, but there are no restrictions on the type of loan, okay? So unlike the down payment assistance portion with TSHAC, with an MCC, it could be a USDA, VA, conventional, FHA loan, okay? TSHAC does not determine the interest rate with a mortgage credit certificate. That's why I love it so much. So your lender is going to determine your rate on that, okay? It says, please note the MCC program cannot be combined with a bond DPA program, just for FYI, okay? Now, are there any restrictions on the type of home one can purchase? Great question. You can do a new or existing home, a condo, townhome, or a house that's in a planned unit development, a PUD, one that has an HOA. You could buy an entire duplex, triplex, or fourplex, as long as you're occupying one of the units, okay? So let's move on here. Right here. What if my income increases? Am I still eligible for the MCC tax credit? The answer will be yes. And just to clarify, this is referencing after you get into a home. If your income increases, yeah, you'll still be eligible to receive up to 20% of the taxable income a year, okay? For eligibility purposes, only when you first apply for the MCC. So, meaning you cannot get an MCC, mortgage credit certificate, after you've gotten into your home. You need to do that beforehand. That's why you need to get with a lender that understands, that is trying to put you in the best position to win, and not just looking for a commission. Relational, not transactional, if that makes sense, okay? What are the fees charged with an MCC? It says your lender will collect the following fees when applying for a mortgage credit certificate. There's a $500 MCC issuance fee and a $200 compliance fee. However, if your profession qualifies for TSHAC's Home for Texas Heroes program, you will receive the MCC for free if you combine with one of the non-bond down payment assistance. This month, the month of November, veterans or active duty military, there's no cost. If you're one of the other heroes, then as long as you're using it in combination with one of the down payment assistance programs, there's no fee, okay? So we just don't want to, we want to let everybody know who's eligible to get this because it's very, very, very beneficial, right? And you know what? Let me get right into it. What happens if you sell the home or move? It says you may be subject to recapture taxes if you decide to sell your home within 9 years, okay? But I don't want that to scare you. Let's get into the recapture tax requirements, okay? Let me blow this up. So a recapture tax, a federal law commonly known as recapture tax, applies to borrowers who buy their homes using the single family mortgage bond programs, right? It says recapture taxes require some mortgagors, that would be you, to repay the government a portion of their gains upon the sale of the home if they finance their home with a mortgage revenue bond. I won't read the whole thing to you. Bottom line is this. In order for a recapture tax to be applicable to you, right? It says here, your household income would have to increase 5% per year, right? From the time or from the qualification income when you got in, okay? So that income would have to increase 5% a year. That's the first thing that would have to happen. The second thing that would have to happen is that you would have to sell your home within a 9-year period, okay, where it's no longer your primary residence. And then the third thing that must happen is that you must have a gain. So all the time that I've been doing these, I've never had someone that hit all three conditions. And the one that usually keeps you safe is that your income is not going to increase that 5% a year. So here are, I won't even get into that. If you want to know the income limits and the requirements, holla at your boy. Get with me and I'll explain that to you. Now, this is kind of grayed out, but I'm going to give you an example, real world example, right? So we're going to start over. And what we're going to do here is, let's say we're buying a $200,000 house. That's the loan amount. And we're going to go $200,000 because we're talking veterans, right? VA loans can qualify for 100% financing of the purchase price. Let's say the interest rate is at 4%. We submit that. If you can see here, in year one, this person could lessen or lower their tax liability by $1,587. Now, let's say in year one, this person didn't have any tax liability that they had to pay. Let's say you have some kids or something of that nature where you get some tax credits. And so what happens is this credit is used before those credits, and essentially you can get a higher return, okay? So this credit will be put in place before your child care credits and things of that nature, thus it allowing you to get a bigger return. Say you didn't owe any money or you came out at even, right? And there's no taxable liability federally for that year. Well, then you could take that amount and you could roll it forward up to the next 3 years. This is huge, okay? So the strategy that I like to have people implement is, look, once you get this tax credit, you can either have your employer manipulate your W-4 and have that money come to you on a monthly basis, and once a year make a principal payment for whatever that 20% is. And more times than not, that 20% is going to be equivalent to one payment, if not more, one principal payment. And if you didn't know, from the first year you get into a home, if you make the equivalent of one principal payment a year to the principal, you'll pay the home off in about a little over 23 years, which is thousands of dollars, okay? So there's several ways to accelerate the payoff of your mortgage, and this is, in essence, free money. And it's free because you bought the house right the first time. So there you have it. I don't want to talk your ear off. The point I'm trying to make is this, right? It matters who you deal with when you're doing business, okay? If they don't know about these things, you can't go back and get it. You're only a first-time home buyer, essentially once, maybe twice in your life if you have not had interest in a primary residence in the last 3 years. But here's the deal. If you don't know, you just don't know. And what you don't know can and will hurt you. So if you're interested in finding out if this is a strategy that will work for you and your family or in your wealth plan, DM me, send me a message, call me. My information is out there. We would love to schedule a call and have a loan consultation to help you determine the best strategy, the best wealth strategy for you and your family. So there you have it. My time is up. I don't have any comments. I thank you for yours. As I always say, especially this weekend, it's a long weekend, right? So be good to one another. Let grace abound. And until the next time, peace.